Hi, and welcome to another episode of Mike's Investing. So I have another great show for you today. So today we're going to talk about the Chinese economy, but more specifically, the Chinese real estate and how the market has essentially been imploding over the last year. So we're going to talk about kind of how it started, how it progressed, where we're at right now, where I see things going, and how it affects you if you're outside of China. So with all my videos, please like, subscribe, leave a comment. All right, so let's go ahead and begin. So back in August of 2020, the Chinese government was trying to tamper down the real estate market because it had been quite hot and this bubble had been building over the past decade. And they didn't want it to burst, but they wanted to slowly let the air out of it. Now, the problem is they didn't realize how bad the situation already was. So when they came out with a new policy called the 3 red lines, what that did is it limited how much the developers could borrow for the projects that they were working on. Well, the problem is most of the large developers were way past what this line allowed. And it cut off essential funding to very large companies with huge developments. Now, you've probably heard of Evergrande, in which they were arguably the largest developer in China, and they ended up defaulting on their loans. And I believe that was December of 2021 that they defaulted. Now, other large developers besides Evergrande have also defaulted as well. So you have all of these citizens in over 100 different cities that have now stopped paying the mortgage on the properties that were being built. So essentially one of the, something that's very big in China is you would start paying the mortgage on the property before it's even built, and that gives the funding for building materials and everything else. Well, you have all of these housing complexes, these large apartments, these huge condo buildings that essentially are sitting vacant and unfinished. Now, over the years, a lot of people could see this problem growing. I mean, heck, it's been in the news to where you'd have, small cities that a good portion of the buildings were vacant. You had malls that were vacant, that were built, but nobody ever went to them, or they weren't completely finished. They were just kind of propped up. And it's created a lot of problem because when you look at the real estate market in China, it is approximately 30% of their economy compared to in the US to where it's 15%. So now you have hundreds of thousands of citizens that are defaulting on their loan. They're not paying them. So now that's severely affecting China and their economy, and it's starting to slow it down. Now, this could be a contagion that does affect other parts of the globe. So the United States could be affected and other countries as well, especially if you export a large amount of goods to China. If they end up going into a pretty steep recession, that could affect us trying to sell them our products. The other thing too that has been going on is the new sales in the real estate market in China are down over 50% this year. You think in the United States, if we had a 50% drop in real estate, that would have quite some effect. So what the Chinese government is trying to do is they are trying to lower interest rates, which would make it a little bit easier to borrow, but they're also starting to add stimulus and add additional liquidity into the market. Now, whenever that you do that, you can create another issue, which is inflation. So if the Chinese government does like the United States government and many other governments have done by adding in too much liquidity, it could create inflation, which then would make it much more expensive for Chinese companies to build products, which would then take that cost and then put it onto the consumer, being the United States or any other country who were looking to purchase cheap China goods. So that's about it. So thank you again for watching Mike's Investing. Please like, subscribe, and leave a comment.